Hello everybody and welcome back to the channel. Now we all know that the financial world can be a very complex place and the financial decisions we make often involve a high degree of uncertainty and risk and involve factors that are difficult to analyse for the everyday person. Now as humans we tend to use mental shortcuts known as cognitive biases to help us with such difficult decisions. In today's video I'm going to go through my top 5 cognitive biases that may be costing you money, so stick around. But first, if you're new around here, my name's Josh. I'm an ex-NHS physiotherapist turned property investor, and on this channel we talk about everything related to business, finance, personal development and property. Make sure you subscribe so you don't miss out my future videos. The first cognitive bias on my list is known as the sunk cost fallacy. Now this is the idea that people see sunk costs, such as the amount of money already invested or the amount of time they've already spent, as a reason to continue with that decision or that financial project, regardless of whether it's still financially viable in the long term. Basically, people get to the point where they've invested that much money, they've invested that much time, that they don't want to waste what's already invested. However, in reality, this is only going to lead to further irrational decision making as people invest more time and more money into that financial project, knowing that they're losing money or they're not getting the returns that they're expected. For example, somebody might want to hold on to a losing investment and keep investing more money and more time on the hope that they're going to recoup their losses over time, even though deep down they know it's a bad investment and they're just going to lose their money. Alternatively, people might be 15, 20 years deep into their career and they've taken all that time and all that effort to get to that point. And even though the financial rewards aren't there, they're unwilling to change jobs and start again from fresh because they don't want to waste the 15 or 20 years of their life, invested into their previous job. I think in really simple terms, and I think everybody's definitely experienced this at least once, is if you think about when you buy a cinema ticket and go see a film, okay, so you pay £6 or £7, you get 20 minutes, 30 minutes in the film and you realise the film is completely terrible and deep down you want to leave, because it's a waste of time, you're not enjoying the film and your time could be spent better elsewhere. However, because you're already financially committed to that £6 or £7 cinema ticket, you stick it out until the end, and then you waste 2 hours of your life on a film you do not enjoy. So to avoid this sunk cost fallacy, it's important to take into consideration the future financials of the deal and not be overly focused on the investment already made. Additionally, it's really good to speak to impartial people not involved in the financial deal and get their views as well. So the second cognitive bias on my list is known as confirmation bias, and this is the human tendency to seek out information that supports our beliefs and ignore information that contradicts them. Now, in terms of finances, this is really problematic because it can result in us making financial decisions based off, incomplete information or biased information. For example, let's say a person really likes one particular type of stock. They will naturally gravitate towards reading news articles and find out information that is favourable towards that stock. And any information they come across that goes against that stock, they'll tend to ignore or discredit. Alternatively, if you're looking to buy a house in one particular area, you always run the risk of radiating towards information which, paints that particular area in a really favourable light. And any news articles or information you get that says that area isn't so nice, you tend to avoid. To avoid confirmation bias, it is super important that we, explore all the information available to us regarding our financial decision or the topic in hand so that we can make an informed decision. The third cognitive bias on my list is known as anchoring bias, which is when people rely too heavily on the first piece of information they receive before making that financial decision. And basically this results in us making decisions based off one piece of evidence rather than taking into account all sources of information available to us. A great example of anchoring bias is during investment opportunities. So for example, you may be presented with the potential returns on a stock or company, and let's just say it's 10%, and that's the first piece of information you receive about the whole deal. Now with anchoring bias, because we've received that information first, we'll pay more attention to that piece of information. So we'll get wrapped up in the idea that this stock or company can return 10%. And over time, as we learn more about the deal, we'll pay less attention to the negatives or the risks because the first piece of information we received was that potential 10% return on investment, which is obviously very good. We also see this a lot in property sales in the UK. Let's just say there's a house up for sale for £200,000, okay? That's the first piece of information you received about the house. You go view the house, you really, really like it, and you think you want to put in a cheeky offer of £180,000. Okay, the seller accepts, everybody's happy, the seller sold the house, and you as a buyer, you're happy because you think you've saved £20,000. However, late that evening, you go on Rightmove and you find similar houses on the market, for £150,000, which you could have bought. So in real terms, you paid £30,000 over the odds because you were so anchored on the information, the first piece of information given, of that £200,000 selling price. To avoid anchoring bias, it is really important to take in consideration all the information available to us and not just focus on that first bit that's given. The fourth cognitive bias on my list is known as loss aversion, and this happens because people prioritise avoiding financial loss over acquiring financial gain. And the reason for this is because people's emotional response to financial loss is simply just stronger than the emotional response to financial gain. For example, we may be offered, an investment opportunity with high risk, with the potential of, high financial rewards. However, people may want to avoid this because they don't want to, lose any of their money. It's also seen a lot of people with large, cash savings, people with lots of cash in the bank, rather than investing their money and getting a return over time, they want to protect their cash and keep it safe and avoid any financial losses, even though that over time with inflation, the value of their money is only going to reduce anyway. So another great example of this is the coin flip analogy, and I'll put this up on screen now to show you. So basically imagine that you had £100 in your savings and somebody offers you a coin flip deal. So for every time you win, they'll give you £50, but for every time you lose, you have to give them £40. Now looking at this, some people would even consider this deal. They think this is a bad deal, it's too risky for them and they won't take it. However, what a lot of people don't realise is that based on each flip, the expected value or the expected outcome is plus £5 to yourself. So over hundreds and thousands and tens of thousands of flips over time, you're statistically likely to end up with more money than what you began with. And with this coin flip analogy, lots of research has shown that people won't even consider taking the deal unless the potential reward is double of the initial risk. So in this example, lots of people wouldn't take this deal unless for every time they won, they received an extra £100 on top rather than just the £50. Again, I think this just shows just how people will prioritise avoiding financial loss over acquiring financial gains. In order to avoid this sort of bias and avoid this sort of thinking, we need to be thinking long term with our financial decisions. The fifth and final cognitive bias on my list is known as social desirability bias. And this is where people tend to modify their behaviour and act differently based on what they think is expected of them by other people or what is expected of them within societal contexts, rather than living their true selves, and living a life true to their beliefs and their own preferences. Now, in finances and personal finances, this is a really, big and important problem because people would rather conform to those societal standards rather than make financial decisions based off their own values and their own goals. Due to this bias, people may be more inclined to pursue certain careers or buy certain things like a fancy car and a fancy house, not because it's what aligns to their own values and what they truly believe in, but because it's socially desirable and it's what other people are doing. And you might have heard of phrases such as keeping up with the Jonases or keeping up appearances. Basically, this explains this concept. So basically, you're letting other people's spending and other people's views, you're letting that determine how you spend your own money. However, not everybody's financial situation is the same. So, buying that new BMW or buying that new Mercedes car on a finance deal that you cannot afford just for the sake of trying to fit in and being looked on favourably by other people is going to cause you long-term financial problems that are your responsibility and nobody else is going to be able to help you with that. To overcome social desirability bias, it's really important that you're truthful with yourself. You take into consideration your own personal finances and what you can and cannot afford. It's also really important to set yourself up with a good support network where you can bound ideas off people and get their advice also. Only by doing this will you be able to lay a strong foundation for your financial future and also your financial well-being. For the last little bit of the video, guys, I just quickly wanted to show you this report from the Office for National Statistics. Really good, really interesting. Again, it's just an expansion on the whole idea of social desirability bias, getting yourself into debt, buying things you don't need, and your financial well-being and also your mental health well-being as well. So yeah, really, really interesting. So this takes, these are people from January of 2022 in comparison to January of this year. So it shows that 22% of adults are borrowing more money in comparison to last year. 42% of adults don't expect to save anything in comparison to only 36% last year. And 31% of adults think they're unable to afford an unexpected expense in comparison to 28% last year. So you can see increases, from this year in comparison to last year. And it was this bit at the bottom as well, again related to the mental health side of things. So this is obviously comparing people who have used more credit this year or people who have used less credit, credit cards, bank loans, that sort of thing, against metrics like life satisfaction, happiness, anxiety. And you can see from the graphs here. So people basically, the notion is that if you're using less credit or you're not using more credit, the people scored higher in life satisfaction, higher in happiness, and lower in anxiety as well, whereas the people who are using more credit scored lower in life satisfaction, lower in happiness, and lower anxiety. So this sort of puts a statistical side on things, and again, it's kind of what I was saying in my previous point, taking out those financial commitments, those finance plans and those products you don't need and you can't afford, it's only going to cause you more problems in the long term. So that is it for today's video, guys. I hope you enjoyed it and I hope you learned a thing or two. But now I want to know what you guys think. Have you unknowingly used any of these cognitive biases in the past? I know I certainly have, and I'm trying my best to avoid them going forward in the future. Any questions, any comments, leave them down below and I'll certainly get back to you. If you enjoyed the video and want to see similar content from myself, please consider subscribing to the channel. It really helps me out, and I'll see you next time.